Since the 1970s, there have only been 5 instances where gold prices exceeded 3 standard deviations above their 5-year moving average, including the current rally we're witnessing. Even more remarkable is that gold is now showing its highest annual return since 1979 with a staggering 42% gain. That level of performance is significant by any historical measure. For context, while investors have continued pouring money into the S&P 500, gold has drastically outperformed it. From the beginning of 2024 until now, the S&P 500 has risen around 35%, but gold has surged by nearly 80%. Gold is sitting at an all-time high, and that reflects a strong shift in investor sentiment. The market is clearly bullish on gold, and it's delivering real outsized returns in the short term. Looking at the broader historical trend, gold tends to outperform equities during periods of market stress. We saw this relationship play out during the 1970s era, the early 2000s, the post-2008 in 2020, and now again following the economic instability of 2024. Gold rallies most aggressively during moments of extreme uncertainty, or what we call tail risk scenarios. In those environments when fear dominates and traditional risk assets start breaking down, gold becomes a preferred hedge and safe haven. That's the dynamic currently driving this extraordinary surge. At Gleneas, we are watching these commodity market trends closely. Gold, unlike equities, doesn't produce cash flow or yield, and lacks a reliable benchmark for valuation. That makes it extremely difficult to determine whether it's in a bubble or not. For instance, gold experienced a sharp spike in the 1970s, but then took nearly 30 years to return to its previous peak. Over the past 50 years, this index has shown clear cyclical behavior. What we're seeing now is a straightforward reflection of supply and demand dynamics. Fewer market participants are buying or holding dollars. The dollar's value is fundamentally set in global confidence in the US economy. When that confidence weakens, or when global demand for dollar-denominated assets declines, the index naturally moves lower. Right now, the drop is being driven by structural headwinds, including tariff policies and a rapidly expanding national debt. That said, the dollar still represents a critical position in the global markets relative to other currencies. It remains the world's reserve currency, and large-scale international transactions, even those that don't involve the US, are still settled in dollars. If we overlay the price of gold, we find that gold goes up when dollar is down, and vice versa. Gold could very well be a function of the US dollar. Because when we mentioned the factors influencing gold, those affect the US dollar as well, like devaluation of the dollar, imports, exports, etc., that all leads to different behavior of agents in economy, and gold is usually seen as safe haven. Therefore, when looking at the chart, comparing the US dollar and gold price, we find a very strong inverse correlation. Also, it's not just investors and traders who are buying gold. This is precisely why we say gold tends to anticipate the effects of monetary policy. A price surge like the one we've seen in recent months can't be explained by investor activity alone. If we look at this chart, we can see that gold is being heavily bought by central banks. We saw a similar pattern in the 1970s, when central banks were also major buyers. But starting around 1980, that trend reversed sharply, and central banks began selling off gold. This continued until around 2015, when gold once again started to be accumulated heavily as a major component of foreign reserves. Central banks have actually started selling large amounts of US treasuries and shifting their focus to gold instead. 10 years ago, gold was around $1,100. Now it's over $3,700, meaning a gain of more than 200%. There you have it again. The dollar is down and gold is up. Since the onset of COVID-19 in early 2020, the US Consumer Price Index, CPI, has increased by nearly 25%, indicating a significant rise in the general price level of goods and services. As a result, the US dollar has lost roughly 19.87% of its purchasing power over this 5-year period, meaning consumers today need nearly $125 buy what $100 could in January 2020. The steepest acceleration in prices occurred between 2021 and 2022. Also, over the past years, the United States has consistently run a trade deficit, as reflected in persistently negative net exports. This means the country is importing more goods and services than it exports, which increases the demand for foreign currencies and decreases demand for the US dollar in global markets. Over time, this imbalance contributes to the downward pressure on the dollar's value. None of the information provided should be considered financial advice or an investment recommendation. Our goal is serving you the best educational content. Thanks for watching. This is Gleneas.